Hello, my name is Doug Greenberg. I'm the president of Pacific Northwest Advisory. Thank you for watching the November edition of 5 Slides in 5 Minutes. Over the past year, the oil industry has seen a surprising uptick in demand, but a slight drop in price. A lot of this has to do with countries outside of OPEC, like the US, Russia, and Iran, ramping up production due to policy changes and relaxed restrictions. Looking ahead to 2024, we're expecting demand for oil to keep climbing. OPEC will probably keep a tight leash on supply, which might tighten the market even more. But there's enough oil in reserve to keep things from getting too wild if demand suddenly shoots up, delaying any major market surges. OPEC wants to keep the price of Brent crude oil between $80 to $100 a barrel. They're setting a minimum price and using their extra oil to keep prices from going too high. This should be good for investors, but if non-OPEC countries pump out more oil, or if the global economy hits a rough patch, prices could fall. For 2024, our bet is on Brent crude averaging about $92 a barrel, thanks to strong global economy, more demand, and people using more jet fuel. In the US, oil production might slow down a bit because of less drilling and better efficiency. OPEC's careful policy changes should keep prices steady. Even with lots of oil to go around, refining it into gas and other products could still be a challenge, which means profits from refining could jump, especially when folks are driving more in the summer months. There's been a lot of talk lately about how much the commercial real estate market, or CRE for short, depends on loans from smaller and medium-sized banks. Some people are saying that these regional banks do most of the lending for commercial properties, and that if these banks hit rough financial waters, it could spell trouble for the whole market. But let me set the record straight. The market is a lot more mixed than that. In reality, all banks combined lend out just over a third of all the money in CRE. And of that, regional banks, which are pretty big but not the biggest, are responsible for just under 14%. The really big banks cover about 12%, and the smaller community banks chip in just under 10%. The smallest local banks, the ones that feel like part of the neighborhood, handle just a small piece. So while banks are important to the real estate market, it's not just the regional ones holding the reins. It's a diverse and wide-ranging field with many different lenders playing their part. The latest financial outlook from Goldman Sachs is taking a fresh look at longer-term investments like bonds. Essentially, we're seeing these as more valuable for investors than before. Why? Well, for one, they're offering better regular payouts, which gives a nice safety net. Plus, if the economy hits a rough patch and central banks cut interest rates to boost things up, having these longer-term bonds could really pay off. They're like an insurance policy against tough times because they usually gain value when other investments might be dropping. Also, if interest rates on these longer-term bonds stay above the rates you'd get on shorter-term cash investments, it makes them pretty appealing. We're suggesting there might be a smart move in having more of these in your investment mix as we head into 2024. And if the markets get shaky because of government debt concerns, this approach could even be smarter. In simpler terms, it might be a good time to consider putting a bit more of your investment eggs in the bond basket, especially those that pay you over a longer time. The global economy is currently in a phase of adjustment, following the swift and widespread response by central banks around the world to the high inflation of the past couple of years. While we've seen resilience in economic activities, a general slowdown is evident. Inflation too is easing as supply and demand are getting realigned. For 2024, the forecast is a continued deceleration in growth for most G20 countries, with a period of subdued activity before things start to pick up again in 2025. This slowdown is largely driven by higher borrowing costs and stricter lending standards, which makes everything from buying homes and cars to business expansions more expensive. As we move through 2024, debts taken at previous low interest rates will transition to the higher current rates, impacting both individuals and businesses. This scenario will have varying impacts across countries and sectors, but generally, we're looking at a squeeze on business profits due to slower revenue growth, tougher funding conditions. Consumers are likely to become more price conscious, reducing demand for more expensive items, which could lead to increased financial challenges, especially for smaller businesses. In terms of numbers, we're expecting G20 growth to moderate to 2.1% in 2024, down from 2.8 in 2023, and then to pick up to 2.6 in 2025. Advanced G20 economies might see growth slow to just 1% in 2024 before recovering to 1.8 in 2025. Emerging market economies are predicted to slow down as well, but will recover slightly faster. However, it's important to remember that predicting the economic outlook for 2025 is quite challenging due to many potential variables, including political changes, geopolitical developments, and environmental factors. Bonds have historically had less drawdown relative to equities, serving an important capital preservation role. The chart we're looking at compares the performance of the Bloomberg US Aggregate Bond Index and the S&P 500 index during various economic events from 2010 to 2022. For instance, during the flash crash between April and July of 2010, the S&P 500 fell by over 15%, while bonds showed a positive return of 3%. Similarly, during the US debt downgrade in 2011, stocks dipped almost 19% and bonds were again positive by over 5%. This pattern, where bonds tend to offer some buffer or even positive returns when stocks decline sharply, is consistent across several events. Notably, during the COVID-19 crash, while stocks plummeted by nearly 34%, bonds decreased by less than 1%. However, during the 2022 inflation and Russia's invasion of Ukraine, bonds also took a hit, declining by over 15%, along with a 23% fall in stocks, primarily due to the increase in the interest rates. This visual underscores the diversification benefits that bonds can offer during stock market downturns, although they are not immune to market stresses, as seen in the most recent data point. Thank you for taking the time, and please let me know if you have any questions or would like any clarifications. Thank you.